Have you ever noticed how almost everyone talks about making money, but very few people talk about how wealth actually evolves? Because the truth is, the way someone with $1,000 invests is completely different from the way someone with $100,000 invests. And the way someone with $100,000 invests is almost unrecognizable compared to how a billionaire allocates capital. Yet most financial advice treats everyone as if they're playing the same game. They're not. In fact, one of the biggest misunderstandings about money is believing that wealth building is a single skill. It isn't. It's a series of stages, and every stage requires a different mindset. What works at one level often becomes a limitation at the next. The investor who successfully grows their first portfolio is solving a very different problem than the investor managing hundreds of millions of dollars. And the billionaire? At some point, they stop focusing on returns entirely. Their attention shifts somewhere else, toward influence, control, and eventually, impact. Today, I want to walk through that journey, not as a fantasy, not as a get-rich-quick roadmap, but as a way of understanding how money changes as it grows and how the psychology behind investing evolves with it. Because the most interesting thing about wealth isn't the numbers. It's how your relationship with money changes at every level. And by the end of this video, you may realize that building wealth has less to do with chasing returns than most people think. It starts much smaller than that, much more human. It starts with uncertainty. Most people enter investing the same way. They're nervous. Maybe they've saved a little money. Maybe they've watched videos, read articles, listen to podcasts. But when it comes time to actually invest, something feels uncomfortable. Because learning about investing and becoming an investor are two completely different experiences. Reading about market volatility is easy. Watching your own money drop 15% is different. Suddenly, it becomes emotional. Now every headline feels important. Every market decline feels personal. Every decision feels permanent. At this stage, the biggest challenge isn't finding the perfect investment. It's learning how not to sabotage yourself. Most beginners believe investing is primarily about intelligence. But behavior matters far more. You don't need extraordinary knowledge to start. You need consistency. And consistency sounds simple until real life gets involved. The rent increases. The car needs repairs. A family member asks for help. Work becomes stressful. Unexpected expenses appear. And that monthly investment contribution suddenly feels optional. This is where many people get stuck. Not because they're incapable, but because investing competes with immediate life demands. The future always feels less urgent than today. Psychologists call this present bias. Our brains naturally place greater value on immediate rewards than future benefits, which is why spending feels effortless while investing often feels like sacrifice. So the first stage of wealth building isn't really about growing money. It's about building habits, small deposits, automatic contributions, learning patience, learning that wealth rarely arrives dramatically. It accumulates quietly, one deposit at a time, 1 month at a time, 1 year at a time. Eventually, something interesting happens. The portfolio starts becoming noticeable, not life-changing, just noticeable. The account balance begins growing faster than your contributions alone. For the first time, compound growth becomes visible. And this is usually where people have their first major investing realization. Money can work, not just people. For years, you've been exchanging time for income. Now you begin seeing a second system operating in the background. Your capital starts producing capital. At first it's small. Then gradually it becomes meaningful. This stage is exciting because confidence starts replacing uncertainty. The investor begins understanding market cycles. They stop reacting emotionally to every headline. They're no longer checking their portfolio 10 times a day. They've survived downturns. They've experienced recoveries. They've developed perspective. But another challenge appears: complexity. Because once money reaches a certain size, people become obsessed with optimization. They start searching for the perfect stock, the perfect strategy, the perfect prediction. Ironically, this often hurts performance. The desire to maximize returns can lead to excessive risk-taking. Overconfidence becomes the new danger. And overconfidence has destroyed more fortunes than ignorance ever did. The investors who continue progressing usually learn a difficult lesson. Successful investing isn't about being right all the time. It's about avoiding catastrophic mistakes. This realization leads to the next stage. Asset allocation. At first glance, asset allocation sounds boring. But among serious investors, it becomes one of the most important decisions they'll ever make. Because as wealth grows, preservation starts becoming just as important as growth. Imagine someone with a few $1,000s. A temporary market decline is frustrating. Now imagine someone with $50 million. A 50% decline doesn't simply affect a portfolio. It affects businesses, employees, families, opportunities, entire ecosystems connected to that capital. Suddenly risk looks different. The conversation shifts from how much can I make to how much can I afford to lose. This is where sophisticated investors begin building systems rather than placing bets. Stocks, bonds, real estate, private businesses, infrastructure, cash reserves, different assets serving different purposes. Not because diversification is exciting, but because resilience matters. And resilience becomes increasingly valuable as responsibility grows. Then comes another shift that most people never think about. Taxes. When portfolios are small, taxes feel like a minor inconvenience. When portfolios become enormous, taxes become a strategic consideration. At higher levels of wealth, generating returns is only part of the equation. Keeping those returns becomes equally important. Investors begin working with teams. Accountants, attorneys, advisors. Structures are designed not simply to increase wealth, but to improve efficiency. The game evolves again. And this is where wealth starts becoming less visible. Because the public often assumes rich people focus primarily on earning more money. Many don't. They focus on managing systems that already exist, protecting assets, coordinating capital, maintaining long-term flexibility. From the outside, it looks like they're investing. Behind the scenes, they're often managing complexity. But eventually another door opens. A door unavailable to most investors. Private markets. For many people, investing means public markets. Stocks traded on exchanges. Funds available through brokerage accounts. But large pools of capital gain access to opportunities that never appear on public markets. Private equity, venture capital, direct ownership stakes, infrastructure projects, large-scale real estate developments, entire companies. At this level, investors are no longer simply buying pieces of existing systems. They're helping create new ones. Capital becomes a tool for shaping businesses before the public ever sees them. And this changes the nature of investing entirely. Instead of asking, which company should I buy? The question becomes, which company should exist? That's a very different conversation. It's also where influence begins emerging. Not political influence, not celebrity influence, economic influence. The ability to direct resources toward specific outcomes. And this leads us to one of the most fascinating psychological shifts in wealth building. The point where money itself becomes less important. That sounds strange, especially to people struggling financially. But numerous investors have described reaching a stage where additional wealth provides diminishing emotional satisfaction. The 10th million feels different than the first. The 100th million feels different than the 10th. Because eventually basic security has already been solved. Comfort has already been solved. Freedom has already been solved. So the motivation changes. For some people, it becomes legacy. For others, competition. For others, curiosity. They continue building not because they need more money, but because they're interested in what capital can accomplish. This is often where billionaires begin thinking less like investors and more like architects. They're no longer asking how to participate in the market. They're asking how to influence the direction of entire industries. Energy, technology, healthcare, transportation, media, artificial intelligence, global infrastructure. The scale becomes difficult to comprehend because the objective has changed. The focus is no longer individual returns. It's system design, capital allocation at a societal level, and whether we agree with their decisions or not. This represents the highest stage of wealth building, not accumulation. Influence, the ability to move resources in ways that affect millions of people. At that level, investing begins looking less like personal finance and more like governance. Not governmental governance, economic governance. Deciding where resources flow, what gets funded, which ideas survive, which industries expand, and which futures become possible. Now here's the part one think matters most. Most people watching this video will never manage billions of dollars. And that's perfectly okay, because the real lesson isn't about becoming a billionaire. It's understanding that every stage solves a different problem. The beginner is learning discipline. The growing investor is learning patience. The experienced investor is learning risk management. The wealthy investor is learning efficiency. The ultra-wealthy investor is learning capital allocation at scale. Different stages, different challenges, different mindsets. And perhaps the biggest mistake people make is trying to think like a billionaire before mastering the basics. You don't need private equity if you haven't built consistent investing habits. You don't need complex tax structures if you haven't created reliable savings systems. You don't need sophisticated opportunities if you're still struggling with emotional decision-making. The foundation always comes first. And that's actually good news. Because wealth building becomes much less intimidating when you stop comparing your Chapter 1 to someone else's Chapter 20. The next useful step is usually simpler than we imagine. Saving consistently, learning patiently, avoiding unnecessary mistakes, giving compound growth time to work. Not glamorous, not exciting, but incredibly powerful. And maybe that's the most overlooked truth about wealth. The headlines focus on billionaires, the private jets, the massive acquisitions, the market-moving decisions. But those stories often distract us from the reality that every large fortune started with smaller decisions repeated consistently over time. The journey always begins with someone learning how to delay gratification, manage risk, stay patient, and keep going when progress feels invisible. So if you're early in your investing journey, don't worry about controlling markets. Don't worry about directing industries. Don't worry about billion-dollar decisions. Focus on the stage you're in. Master the lesson it has to teach. Because wealth isn't built in one giant leap. It's built through a series of transitions, each one preparing you for the next. And while the numbers may grow dramatically along the way, the underlying principle remains surprisingly simple. Money grows best when patience grows with it. And progress, almost always, beats perfection. If this perspective changed the way you see money, don't just leave it here. Take one small investing habit and start building it today. And before you go, I'm curious, at what stage do you feel you are right now in your own money journey? Just starting, building, or optimizing? If you want more deep, psychology-driven money breakdowns like this, subscribe and stay with me for the next one.